saying inflation slowing now for a second month to 4.8%, but of course it is still well above the Bank of England's target. That is just one of many challenges facing the UK economy right now amidst a darkening growth outlook. Well, Spencer Dale, Chief Economist at the Bank of England, joins us now for an exclusive interview. I also have with me our economics correspondent, Linda Yueh, to bring her analysis to the table here as well. And Mr. Dale, thank you very much indeed for speaking to us. I know that you've been at Bloomberg all morning talking about the outlook for growth here in the UK and, of course, the prospects for more stimulus. Let me start by asking you about these inflation numbers coming in below 5%. So we're seeing signs that inflation is slowing, but of course we're still well above the 2% target. How soon before we get right back down there?
So you're right, inflation is starting to slow, and I think what we should do, what we expect to see, is a very sharp slowing in inflation in the first quarter of next year. There's some very large base effects associated with the increase in VAT and an increase in oil prices, which happened around the first quarter of this year. They will stop adding to inflation in the first quarter of next year, and so I expect to see inflation fall sharply next year, to hopefully to the low threes by around March of next year.
Which provides more room to manoeuvre, more flexibility when it comes to further stimulus?
Well, I think the most importantly is for households whose incomes have been squeezed by high inflation, their real incomes have been squeezed, that squeeze should start to ease after as inflation comes down, and that should hopefully help to provide some support for our economy.
Spencer, the bank's central forecast is that growth will be essentially flat through the middle of next year. What is the probability of a recession then in that instance?
So I'm not sure I have some sort of particular number about the probability of a recession, and I'm not sure that's particularly, for me, a helpful way of thinking about the growth outlook. I think what matters for most businesses, and certainly what matters for most households, is whether the economy is growing sufficiently quickly to get order books back up to normal and to get unemployment down again and people feel more secure about their jobs. And frankly, if the economy is growing at minus 0.1% or plus 0.1%, that doesn't really make any difference to those households. The key thing is the economy is not growing quickly enough in order to get order books back up and unemployment starting to come down. That's the outlook for the next few quarters, and that's the reason why the MPC in October decided to do more quantitative easing.
Do you think with quantitative easing, you've affected those probabilities enough? Because I completely understand what you're saying, but perception matters a lot in this kind of market, doesn't it? That if you have a negative quarter or a positive quarter, the economy is shrinking or not. So if you're projecting 0% growth, there's a 50% chance of it being above and below that line. And I would say that if the UK is shrinking, that's going to send worrying signals, actually, to the markets and to the broader economy, confidence of households, for instance.
Well, so I think there's a strong evidence to suggest that the quantitative easing had a big impact during 2009 when we did it the first time around, and I'm equally confident that quantitative easing should provide important support for activity and the economy this time around. There's a time period by which monetary easing can affect the economy. We can't wave a magic wand today and stimulate growth tomorrow, so I expect these effects to come through over time. But you're quite right, we expect flat growth over the next few quarters, but thereafter I do expect to see some gradual pickup, or hope to see some gradual pickup in the economy, in part because this squeeze we were just talking about on household incomes should ease as inflation falls down, and that should provide some support for the economy.
On quantitative easing, the Bank for International Settlements has issued an analysis, and they think there might be diminishing returns from it. So how much more would need to be done to counter the fact that you could actually get a little bit less bang, given that the more you do, the less effect it has, according to the BIS?
So I haven't read the BIS paper in detail. I mean, a key message from the BIS paper was quantitative easing works, and that it can have a long and lasting effect on real incomes and have an important effect on the economy. They come up with slightly different estimates than ours, but I think there's all sorts of technical factors which can explain that. The key thing is quite recently the Bank of England hosted a conference on quantitative easing where we brought academics and central bank economists from around the world to the bank to discuss their estimates of quantitative easing. And one of the messages I took away from that conference was there's a growing body of evidence, both from the UK and the US, that the quantitative easing works. And moreover, those estimates were over ballpark similar numbers to what the Bank of England produced. And I'm not sure there's anything in the BIS estimates which are going to sort of in any way change that emerging international consensus.
If I could just ask, though, one of the points that was made in that BIS report was the fact that with yields already so low, how effective can further stimulus be? Is that something that is under consideration?
Yes, and one of the points I made in my speech today, which I presented at Bloomberg, was trying to think about some of these sort of myths and criticisms that people make. And one question is, well, will it work if yields are so low? And I made 2 points in response to that. One is, although short-term yields are low, longer-term gilt yields are higher, and there's scope for them to fall. But more importantly, the aim of QE is not to reduce government borrowing costs, it's to reduce the borrowing costs faced by UK companies and households. The spread of those rates, which companies can borrow, has increased over gilt yields recently as markets have become more risk-averse and have shifted into safer assets. The aim of QE is to directly push back against that mechanism, reducing the supply of gilts and encouraging investors to invest in other types of assets, including UK corporate bonds and equities. And that's the way in which QE should work.
Yeah, no, you certainly made that one of the 5 myths that you busted. Can I also just point you back to this idea of more quantitative easing, which I know will be under consideration? £125 billion is what the OECD expects that you'll need to do. Are they in the ballpark? Is that right? Is that warranted?
I have no idea what we're going to need to do. If we knew what we were going to need to do, presumably we would have done it. I mean, the economic outlook, I think, is very uncertain at the moment. There are risks to the downside, as I explained in the speech, that with growth this week and the possibility that events in Europe could escalate, there's a risk that growth could be weaker, and in response to that, the role of monetary policy would be to support the economy. But likewise, I also made the point that inflation is at 4.8%. Our target is at 2%. Although we expect inflation to fall sharply in the first quarter of this year, that will get to a number of around 3%, or in the low threes. What's far more uncertain and far more important for monetary policy is how quickly inflation falls from beyond the first quarter of next year. And that will be another key factor determining the path of monetary policy.
Actually, this is an interesting issue, Spencer, which is the bank's obviously looking ahead when you look at the effect of inflation. So you always have a longer-term window, don't you? You don't really look at the next few months. So why is it that high inflation now could constrain more quantitative easing? So
I think there's 2 reasons why or 2 or 3 reasons why high inflation now could constrain more quantitative easing. Perhaps the most important one is because although we understand why inflation is so high at the moment in terms of these temporary impacts from VAT and from the higher oil and energy prices, our understanding of inflation dynamics is is limited. It's not perfect. We have to recognise as policymakers the limits to our knowledge. And although the direction of travel is clear, inflation is falling. We're starting at a high number, and our target is very clear to hit the inflation target. And so until we get a better sense of the underlying inflationary pressures, I think there will be a nervousness in terms of the extent to which one should keep on stimulating the economy. But on the other hand, as you say, we have to look forward, and if the growth outlook weakens further, then that will be pushing in the opposite direction, and we're going to just keep on having to balance up these 2 risks.
And how far, I know that you said it's really when the base effects come out after the beginning of next year where you can really assess the price path. Now, you said in your speech you are actually a little bit more balanced in terms of the risks that you see to inflation. How are you, just talk us through your assessment of where prices or inflation is headed in the next year or 2, just to give a sense of how you're thinking about the issue.
So I think, as I said, inflation should fall sharply in the first quarter, and I expect inflation to continue to fall thereafter. What I'm less clear about is how quickly inflation will fall. Will it fall quickly to 2%, and if it does, will it carry on falling, or will it settle at some around target? There's arguments why inflation could fall quickly and sharply, particularly in this environment of weak demand. If the labour market remains very loose, that will pull down on costs and prices. But on the other hand, there's a number of factors which could cause inflation to be more persistent, and I went through some of those in my speeches today. If input price pressures may remain high, we may see companies trying to rebuild their margins by raising prices. Productivity growth and hence the supply side of the economy may remain weak. And trying to get a sense of those different judgments, those different factors is hard. And my own personal view is that they're somewhat a little bit more balanced than the best collective judgment made by the MPC in its inflation report in November.
You talked a bit about this in your speech, but I just want to emphasize what I thought was a really key move by the bank last week, which is to open sterling ample credit lines for banks. How big a risk is there of another credit crunch?
So, as I said in the speech, banks haven't been able to, UK banks haven't been able to issue unsecured term debt for most of the second half of this year. That wasn't a major problem for UK banks since they'd done most of their funding, pre-funded for most of this year already by the time those markets effectively closed. And our best guess is thus far we haven't seen a significant tightening in credit conditions faced by households and companies from the already tight levels they were. But and we need those funding markets to reopen, and unless they do relatively quickly, I think there's a real risk that credit conditions in our economy could tighten further.
Mr. Dale, you've spoken very candidly about the limits when it comes to the knowledge of policymakers. Of course, you've got to make policy based on forecasts. But I'm also wondering about things that aren't in your control, external shocks. To what extent is the UK going to be the master of its own destiny in 2012? I'm thinking specifically about the European sovereign debt crisis, which, if it continues to deteriorate, there's only so much monetary policy in this country can do.
Yes, there's a limit to the extent to which domestic monetary policy can insulate our economy from large external events. The one thing that monetary policy can do is, over the long run, achieve our inflation target. We are the masters of our universe in terms of our ability to achieve our inflation target of 2%, and that's what we continue to focus on.
Well, thank you very much indeed. Wonderful to have you on the pulse. Spencer Dale, Chief Economist at the Bank of England. Appreciate your time on the programme. Of course, our economics correspondent, Linda Yueh.